You just bought a rental property. Now what? Well, here are the 5 most important things to do and to keep in mind for that new rental property that you just put into service. Number 1, do you need to put your new rental property inside of an LLC in order to take advantage of the tax benefits? No. Whether or not this is a new purchase of an investment property or it's a conversion of a previous primary residence into a rental property, it does not matter whether it's in your personal name or the name of an LLC. You're entitled to the same deductions either way. The income, in fact, will be reported exactly the same on Schedule E on your personal tax return, whether it's in a single member LLC or your personal name. Putting your property inside of an LLC is not a bad thing to do, but it's going to have legal benefits rather than tax benefits for you, such as the separation between you and this new business activity and the limited liability protection that comes from having it inside an LLC rather than your personal name. Number 2, what are the things that you need to keep track of on your new rental property? Well, there's going to be the obvious things, such as your rental income and all of your expenses throughout the year, such as your mortgage interest, your property taxes, your property insurance, your utilities, repairs and maintenance, things like that. But then there are going to be some other things that are going to be associated with this business activity, such as you might have bought some software in order to keep track of these income and expenses that you have on the property, such as Stessa or QuickBooks. That's an expense for this rental property. And also your travel costs, such as either a mileage deduction to and from the property when you go out to do repairs, show people the property, whatever it might be. Or it could even be if it's out of state that you have to travel down to this property to do things for it. Those are other expenses you're going to have that's associated, again, with this business activity, because that's what a rental property is, a certain type of business activity. So be sure to keep track of not only the ordinary necessary expenses you have for this property, but those other external expenses that are needed for managing this property, such as software, travel, supplies, and things of that nature. Number 3, what are the things I need to get to my accountant at tax time for this new rental property? Well, here are the 3 most important things to get to your accountant. Number 1, a profit and loss statement. Number 2, the mortgage interest statement if you have a mortgage on this property. And number 3, the closing documents from when you purchased this property. Profit and loss statement could be something very simple, especially if this is just owned by you personally or it's a single member LLC. It's just going to be reported on your personal tax return on Schedule E, which means all you need is a profit and loss statement, which just shows the total income, the total rent that you had during the year, and then your category of expenses for each things you paid for during the year. A very simple thing. Again, there's software to help you out with this, like Stessa is a popular one. QuickBooks can even be used. Just something that allows you to keep track of these things. But understand, it does not even have to be in some kind of software. You can just write down these things. You can use Excel, whatever you're most comfortable doing. The second thing, the mortgage interest statement, the 1098, it's going to tell me the total mortgage interest paid during the year. Generally speaking, if you have escrow on this property, it's going to tell me the property taxes paid for this property. And sometimes that 1098 will also tell me the insurance on that property as well. You'll usually receive your 1098 statement in end of January, beginning of February. And the third thing would be the closing statements that you had from when you purchased the property. You know, when you're at the settlement table, the things that the title company gave you. The 3 general documents that you're looking for would be either a closing disclosure, an ALTA statement, or a HUD if you purchased it cash. One of these 3 statements is the information that your accountant's going to need. The reason why your accountant's going to need one of these 3 statements is so that they can determine the basis of your property and the amount of closing costs you paid, so they can take advantage of that depreciation deduction for you. Number 4, depreciation. What the heck is it? So as it relates to taxes, depreciation is the expense you take on an asset you purchased over its useful life. Let me give you an example. So when you buy an asset, which is generally speaking something over $2,500, the IRS says you must capitalize this and expense it over its useful life. Now, how do you determine its useful life? Well, the IRS has what we generally go by, the modified accelerated cost recovery system, which gives us the years for many assets. Like a rental property, a residential rental property is 27 and a half years of useful life, or a commercial property is 39 years of useful life. And what that means is, if I bought a $500,000 property, I'm going to expense that $500,000 over 27 and a half years. But it is a little bit more nuanced than that. Now, generally speaking, homes are on land, which means I'm going to have a portion of my purchase price be allocated to land. The reason why this is important is land is not a depreciable asset to the IRS. So only the value of the building or the improvements upon the land are going to be depreciated over those 27 and a half years. So let's say that I bought a $500,000 property, $100,000 of that $500,000 is land value, meaning $400,000 is building value. That means I'm going to take the $400,000 of depreciable basis, divide that by 27 and a half years, and that is my depreciation deduction, which would be about $14,500 each year that I get as a expense against my rental income. And generally speaking, this depreciation deduction is what creates a loss on your tax return for that rental property, whereas the property itself might have actually generated net income for you. Let's say the profit and loss statement you gave to your accountant had $10,000 of net income after interest, insurance, and all those other expenses you had. But then once the depreciation deduction is added in, at $14,500, you're actually now at a $4,500 loss on that property. That means you have a paper loss, even though you actually made income. Even if your principal payments towards the loan during the year were another $5,000. So let's say you cash flowed $5,000 on this rental property. You would still have a paper loss on your tax return of $4,500, meaning you are $5,000 richer. You have $5,000 more dollars in your pocket over the year, but you're not going to pay any taxes on it because of that depreciation deduction. In fact, that $4,500 may even reduce your income, meaning you have an even better tax picture. And that brings us to number 5. Rental properties produce passive income and passive losses, and you may not always be able to use those passive losses against your other ordinary income. You see, generally speaking, passive losses can only be offset by passive income, but the IRS has an exception to this. If you make $100,000 or less of adjusted gross income, you can take up to a $25,000 loss from your rental real estate against your other income. Like if you have W-2 income of $100,000 and you have a rental loss of $4,000, I can actually reduce my taxable income from $100,000 to $96,000 because of that rental loss. But once I have more than $150,000 of adjusted gross income, I can no longer take these passive losses against my other ordinary income. I can only take those passive losses against other passive income, like passive business income or other passive rental real estate income. There is a phase out between $100,000 and $150,000 of adjusted gross income. And the reason why this is extremely important is because many people, when they go out to buy a second property as an investment, are making well over $150,000. And while they are thinking about all the write-offs and deductions and all the things they're going to get for this property, especially in the first year, they're going to have a lot of repairs and things, that loss is not going to offset their income. And it comes as quite the shock. This is because, again, they make over that $150,000 of adjusted gross income. So even if their property resulted in a $15,000 loss, net loss for them, they will not be able to take that. It's going to be a passive loss, and it's going to carry forward until they have other passive income for it to go against, or until they sell the property, at which time those passive losses will be released and reduce that sale income. But don't let this take away from the fact that real estate is still an amazing investment. Just because you're not getting a second order effect of getting write-offs or deductions for the things that you're losing money on in your rental property, real estate is the best way to build wealth, at least in my opinion. Maybe there's a little bias because I'm also a realtor. Going back to my example in the last point, let's say you had $5,000 more of cash flow from this rental property, but it resulted in a $4,000 loss. Even if you cannot take that loss against your income, you cannot reduce your income by the $4,000, you're not paying tax on any of the money that you just made. You physically made $5,000 more. You are $5,000 more richer, and you're not going to pay any taxes on that. In fact, I have a carry forward loss I'm going to be able to take against future years when that property starts making me positive income. So that's pretty great. I have this investment that is cash flowing me money, making me actually richer just in terms of dollars. And it's going to result in no tax consequence or little tax consequence to me, far less than the money I'm actually making for years on end. And not only that, I have a property that is appreciating in value over time. So my wealth is increasing while the loan is being paid down, further increasing the equity in this property. So while I may not be making oodles of money in terms of the rental income coming in every month, if I have a number of these rental properties, I can begin to really cash flow on these things. But not only that, I'm increasing my wealth. And that is the most important thing to see while not having a huge tax impact. But understand, don't be dissuaded in buying real estate just because you're not going to be able to take these rental losses against your income. That's not the purpose that you should be investing in real estate. You should be investing into anything because it's a good investment. It's going to create a return on the money that you put into it. If that's how you buy your real estate, you will be better off in the long term because, again, the wealth that this builds over time is far greater than the small amount of cash flow you're getting from this property or the small amount of deduction you might be able to get for it. And I know some people will comment and let me know, well, what if you're a real estate professional? You could take those losses against your income. That's very true, but that is a topic for another time and not something that you necessarily need to know right off the bat when you buy your first rental property. So, be sure to keep these 5 things in mind for that new rental property that you just got so that you are ready for this coming tax season and you're not scrambling for all the things that your accountant needs for this new rental property that you have. Thanks so much for watching. Be sure to like, subscribe, comment, and hit the notification bell. And be sure to follow me on TikTok and Instagram where I have a lot more videos about tax topics that I talk about in much shorter form. And you can also tag me in videos on there if you want me to respond to anything. Again, thanks so much for watching. I look forward to seeing you on the next one.